financial topics.
Hello, and welcome to the Physical Therapy Owners Club. I'm your host, Nathan Shields, and today we've got a special event because I'm doing a dual episode, if you will. I'm recording for the podcast and also doing a Facebook Live event with Eric Miller of Econologics. Eric, hey, thanks for being on this first groundbreaking episode with me.
My pleasure, man. I'm feeling like I'm almost a star, but not quite.
But you're a big deal. You're kind of a big deal. So it's awesome to have you. And please, for all those people who are listening on the podcast, we're doing these Facebook Live events with Eric Miller, and we have these planned out for about once a month here over the next few months, different topics related to PT ownership. I've got Facebook Live events with Will Humphreys planned, and those might or might not go out on podcasts. So some things are showing up on the podcast. A lot of stuff is showing up on the Facebook group page. So check it out, Physical Therapy Owners Club. But Eric, today, the reason we wanted to get together is to focus on what people are asking about, and that is some support in exit planning. So where do you want to start the conversation here, man?
Well, hey, look, this is exit planning is kind of a big deal because, at some point, everybody is going to exit out of their practice.
Yeah.
And whether you're just starting in your ownership journey, whether you're mid-career or maybe, you're 3 to 5 years away, it is something that you have to confront. It's something that you have to deal with. And it's better to have a plan of exactly how you're going to exit out. Know that before, because then you can kind of build your business to what the exit's going to look like.
Mm-hmm.
So it's not something that you do, to me, like, when you got maybe a year left. It's something that you really should start doing right away. Even if you're just starting your practice ownership journey.
Yeah, I had a call from a friend about a week and a half ago, and he was calling because he had been approached by some previous physical therapists who worked for him, who were interested in buying his practice. And lo and behold, a few weeks later, he got an email or a postcard or something about someone else who's also looking to purchase PT practices. And he's like, so what do I do? How do I handle this stuff? And I'm like, okay, well, it's now you've got to sit down and actually consider what your ideal scene is. It'd be nice if he kind of had that, not necessarily how the exit was going to happen, but what his ideal scene was. What does an exit look like? What are some of the things he wants? Does he have a next thing to go to? Does he want to work his way part-time out of it? Or does he want to have any management responsibility at all? Some of these things that don't take a lot of mental effort just need to be considered when you're talking about ideals, when you're talking about exiting.
Yeah, I think the two biggest questions you got to ask yourself. Number one, am I emotionally ready to exit out my practice? That's a really key question, right?
That's true.
Because you do not want to exit out when you are in kind of that burnout phase. Like if you're feeling burnout, if you're feeling, that whole concept of burnout.
Yeah.
If you're feeling overwhelmed, that is the absolute last time that you want to think about exiting out your practice. And I got so many stories.
But why is that? Go into that a little bit. Why
well, think about it. Okay, so if you're burnt out, that's usually a condition where you're not really getting full exchange from the practice, meaning that you're putting all this work and effort into it and you're not getting the compensation back that you should.
Okay.
Whether it's money, whether it's time, whatever it is. Okay. Mm-hmm. And that's probably a function of something out in the business. It's not as profitable as it should be. It's not growing as it should be. Your staff isn't coordinated. And that, of course, if you're in that kind of condition emotionally, then that's more than likely going to show up in the numbers, and that's going to bring the value down of the business, right? So I have so many stories of people that I'm like, that have come to me and said, I'm done, Eric, I'm burnt out. I got an offer that seems reasonable to me. I'm going to take it. Right. And I got to try with all my might to say, don't sell right now when you're in that kind of state. Okay.
No, it's
Because
not
it's
the time.
always the wrong thing to do. Like, never make a financial decision when you're in exasperation, worry, anxiety, fear. Never make a major financial decision when you're in that condition.
Mm.
So, what ends up happening is you correct the problems, you get back, okay, I'm in love with my practice again, or maybe I wasn't. That's the time to sell.
Yeah.
Like, that's the time to sell when you feel like you're going out on top, because more than likely the value that you're getting, the money that you're getting is going to be like, wow, this is why I do it. And then that's going to reflect when you sell the practice.
Yeah. I've got a PT owner who, I, I've got two PT owners that contrast each other. One was I started working with about a year ago. Yeah, he was at that stage. He's like, I'm burned out. I'm done.
Yep.
I don't know why I want to do this. And maybe I should just sell out. Um, and now after working with him for a year, he's at a point where, he's working 20 hours a week, and he's got ways to work even less treating patients. He's like, yeah, dude, I'm sitting here in my back office and I can hear what's going on out there, and they're solving problems on their own, and things are getting handled. And I'm like, isn't that such a great feeling to see how that transition and where he's at right now? It's so exciting and fulfilling, right?
Yeah, I think that's the nirvana that everybody's
Yeah.
looking for as an owner.
Yeah. And I've got another guy, a client who I started working with, and during the course of our coaching, he had ramped up his business even through COVID. Like, his 2020 was the best year he'd ever had, numbers he'd never seen before. And someone approached him about selling out, and I was really kind of hesitant. I said, are you sure this is what you want to do? Does it fall in line with your purpose? Does it fulfill your ideal scene? What are you going to do after the sale? And sure enough, he had this amazingly producing clinic, and it checked all the other boxes. He's like, when I sell, it not only gives me this money, but allows me to fulfill this other dream that I have. And I
Yep.
can pursue that full time. And I can see that being equally, if not more, financially viable than my PT practice. And, everything kind of fell in place. And that was such a cool scenario to see go through, because he had a high revving practice. It was performing well. He got to a point where it was doing very well. And he saw where aligning with someone else who was going to buy it was going to even take it to the next level. And that allowed him to then move on.
Yeah. And I think that goes to the second question, right? Because number one, your emotional readiness, and then your financial readiness, right? So you have to look at it, to your point. Your practice is always going to be worth more to you to keep it than to actually sell it. Okay. Especially if it's a fairly profitable practice, like the amount of cash flow that you're going to get from the practice. I mean, that's always going to be more. So, you have to ask yourself, is the value that I'm going to get from the practice, combined with what I currently have in outside investments, is that going to get me the number that I need to live the life that I want to live and let me do the things that I want to do? Right? So, no one should be reliant just on the sale of the practice for their quote unquote retirement. You obviously, while you do own it, you got to make sure that you're utilizing the business to create other income sources as well. And, now there is a number, everyone has a number. Like, what's your number? Like, hey, if I got this much compared to what I currently have in savings, that's enough for me to, create an income source from there that I can live the life that I want to live. Right. And make sure that it's a life that you want to live, not some little, scarce amount that barely gets you by, So those are really the two, I think, to start with. Those are just the two main questions, before you start thinking about exit. Are you emotionally ready to do it? And then are you financially ready to exit out?
When you think about that number, and you being a financial advisor, the industry, that's where financial advisors will say, what's your number, right?
Yeah.
Because this number, and then multiply the rate of return that you could get on it over because of the stock market. Do you use that, or do you go off something else? What do you use?
I got a super simple equation on how we do this, man. It's probably too simple, but first off, you got to start with how much income do you need? Like what would the desired income amount that you need to have, right? So let's just say it's $25,000 a month. Okay, let's just say I want to have $25,000 a month. Sorry, I got my calculator here.
Yeah.
Okay, So that's how much? That's $300,000 a year, right?
Okay.
So how much am I going to need in total assets? Let's say earning a 5% rate of return, because maybe we can find places that can get that. I'm sure we can, right?
Okay.
I'm sure we can.
Sure.
So how much am I going to need in total assets at a 5% rate of return to give me $300,000 a year? Okay. The number's simple. It's $6 million.
Mm-hmm.
6 million at 5% is 300,000. If you don't want to touch the principal, which most people don't.
Yeah.
Right.
Mm-hmm.
So that's a simple equation. So, okay, great. So I need to create a scenario where my outside investments and my practice value and my real estate, is close to that $6 million mark,
Mm-hmm.
so that I can convert that all to an income stream at 5% of $300,000 a year. I mean,
Mm-hmm.
it's kind of that simple.
Okay.
Yeah, at least it gives you a target to shoot for.
Mm-hmm.
And the worst thing you want to do is underestimate that. So I would say, like, whatever your income number is, just that's what it is, right?
Mm-hmm.
And then you build from there. And it does give you a good target to shoot for.
Mm-hmm.
It's not easy,
No.
but it can be done.
Yeah, people might not have, and I don't know which direction you wanted to go next, but I was thinking some people don't know what EBITDA is or how to value their practice. Is there something more important that you'd rather talk about, or do you want to talk about EBITDA?
No, I mean, we can go into like exit options, man. If you want to go in, I will say this though. I mean, your earnings do matter.
Yeah,
they matter a lot.
Mm-hmm.
So, I mean, you can have a $1 million practice, $1 million revenue practice that has, and the difference between one that's very well managed and has maybe a 20% profit margin, and one that is not very well managed and only has a 10% profit margin. I mean, the value between those two companies is probably about $500,000 or $600,000 difference.
Mm-hmm.
Because of the way that your earnings affect the sale. Now that's not the only thing a buyer would want to see. As you know, you've been through a sale. It's not the only thing that they want to see, but my God, it does matter.
Yeah.
So you do have to make sure that you are profitable. You do have to make sure that there's earnings there, mm-hmm. that you can show, so that someone that's going to buy it is like, okay, there's something here for me to buy, and I'm going to give you full value for it because there's this profit that I can see.
Is it safe to say that your company is not going to you're not going to be able to sell it for what you want if your profit margin is in the single digits?
No, yeah. I mean, number one, you're not going to be able to, like, number one, your home life's going to not be very fun because there's no profit there for you to channel to the house, and now you're spending all this time on a really risky asset, and the return isn't what it should be. Mm-hmm. So, and then the value that you're going to get for it is going to be really, really low. So, mm-hmm. We talk a lot about that, and the way to handle that, obviously, is that you really have to incorporate your profits into treat them as expenses. Right? Like, build them in to your, however you do your financial planning for your business. Like, how much does this practice need to make a month? And then I have to incorporate my profits to myself. Well, however much that is, 10, 15, 20%, you got to build them in as expenses and treat them just like bills. Mm-hmm. And when you do that, it does put that extra demand on the business to make more, to cover these expenses. And that's kind of the trick. And if you can do that, and you can do that consistently, now you're going to have a practice that has some value, not only to you personally, but when you sell it, it's going to have value to whoever the new buyer is going to be.
Yeah. When I first heard this concept, it blew my mind.
Yeah.
because and unfortunately, I heard of that concept after I sold my practices.
Yeah.
And so thinking back, I'm like, oh man, if I had set aside 10% of my gross revenues as an expense line for the previous 15 years, my financial situation would be so much different.
You tell that to people, sometimes they almost go into grief because they're like, oh my God, I could have had so much money, but it's never too late, and it is, I think, the fundamental most successful financial action that any owner can do is to set that system up where you do put that owner compensation, that 10% right off the top goes to your household for the express written consent of creating other income sources and no other reason, not for boats, not for second homes, right? To really create other income streams. And then, you get into the financial planning aspect of what I do. Where does it go? How do you invest it? I mean, that's kind of a secondary thing.
Yeah.
But that does so much good for the value of your practice and for your household. I can't emphasize that enough.
Yeah, real life scenario. One of my coaching clients read Profit First. So if you want to read a book about it, Mike Michalowicz has the Profit First book, right? And really walks you through the importance of it. But simply enough, we've already stated what the book, we summarized the book right here, but 1%, you could start with 1%. If 10% is like, that's too much, right? Start with 1% and sit down weekly. Okay, what did we collect last week? And then on Monday, put that money aside into a separate account, right?
Just a separate account.
Just do that on a regular basis and build it from 1% to 2%. And then 2% to 3% until you get to 10%. And what my client found was, as he did this, he, even through the COVID times, he set aside 10% every week. And he, at the end of the year, he was like, Nate, I've got like this little account of $40,000 all of a sudden.
Yeah.
That's just sitting there.
It doesn't take much. Yeah. And I'm telling you, the amount of money that everyone would have if they did that and they put it in consistently and they didn't touch it, it's going to blow them away. But you're exactly right. You got to do it on a gradient because you don't want to overwhelm the organization with a big expense like that right away when it's not ready for it. So you have to do it on a gradient, just like you said. And then just make it systematic and automatic. So you're not really thinking about it. And I think those are the two most important functions there, but it really does a lot of good for your balance sheet, for your profitability of your business and for your household. It is amazing.
Yeah. So tell us next. If people are thinking, okay, I want to sell probably in the next 5 to 6 years.
Yep.
We've gone through, I'm emotional. I will be emotionally prepared. And that's plenty of time for me to really fine tune my stuff, get my revenues and my profit margin up. Then where would you direct them after that?
Well, then I think you really have to kind of decide what your sale option is going to be, because you do have choices, right? I mean, and there's I think there's 7 different exit options that you have, and I know you're going to ask me to recite all of them, and I'm trying to remember all of them right now. But
if you can come up with the top few, that's fine.
If I come up with like 7 of them, that would be a win. But look, I mean, really simply, number one, you could just die with your boots on. Right. I mean, you could be one of those guys that dies with their boots on. That's an exit strategy. You could close the doors, which some people have done. Unfortunately, that's an exit strategy. You could sell to a competitor. That would be an option as well. So someone locally you could sell to. You could gift the practice if you have a child that maybe wants to take it over and you don't really need the income that much. You can gift the practice to somebody else. You could, of course, I think most popularly probably sell to an associate, do some kind of like a management buy-in or a buyout of some kind. You could sell to corporate, which I think is pretty popular nowadays. Or you could sell to your employees through what's called an ESOP plan. Now, not many people do that because you really need to have a lot of earnings and profit to do that. But I think most of you that are thinking about exiting, it's either going to be selling to corporate or it's going to be selling to another PT, maybe a competitor, or some kind of internal buyout, right? Where maybe one of your associates buys you out in some way, shape, or form. I think those are the strategies that you got to look at.
Yeah, I think it's worth like looking forward to what might be the ideal situation for you. Yeah, because when we got we had proposals to purchase our practice like 3 or 4 times before we actually did, and it always started conversations about, okay, are we okay with managing a clinic for somebody else?
Yep.
Do we want to be an employee again? And if we are employees, what are our job responsibilities and what are we okay with? Because the reason why we turned down a couple of them was, okay, they come to us with a 70-30 buyout. They pay us 70% of the value, the purchase price. And we retain 30% stock, but then we were expected to be clinic directors essentially, or even managers of multiple clinics. as full-time jobs with a salary, right? And we would expect to be employees in that regard. And that didn't sit well with us. And we didn't open up our clinics to be employees again. And
No.
so, yeah. And so that made it really easy for us when we actually did sell to say, this is what we want to see. We don't want to be treating patients anymore. We will stick around for some transition. But yeah, you're going to pay us so much up front. This much in stock is what we're willing to. There aren't any earnouts. It's just cut and dry, right?
So earnouts are bad, man. I really would recommend not doing earnouts.
Yeah, talk to us about that a little bit.
Yeah. Well, look, I mean, like when you make a decision, I mean, number one, you're basing it about a formula that you don't really have much control over anymore, right? Now because once someone buys more than 51% of your company, they make the rules at that point in time, so they can adjust what they look at profitability as, and you just don't have much control or say over. I mean, you'd have to have ironclad legal agreements prior to that of how they calculate that before, I would do any kind of earnout like that.
Yeah.
And at the same time, I mean, well, that, and you don't know what the environment's going to be like.
Totally.
I mean,
what if another pandemic comes through?
Exactly. So you're like, I mean, you're basing it on, some kind of a prediction that we're going to stay exactly where we're at. And, some may, but I mean, you just look, I mean, no one saw this coming. So, I mean, that would have, people that were based on earnouts right now, they're probably like, oh my gosh, having to go back and renegotiate that. So I would just look, if you're done, just be done. Right. And, I would say, the way that you did it is just try to get as much as you can up front. If you do have to leave 10%, if you do have to stay on for maybe a year, then that's fine. But just, that's why it's so important to have your next game. And I would just try to get as much as I can up front, because again, you don't have any control over how that corporate groups, and maybe they're really awesome, and maybe you will get this huge multiple down the line, like they all promise that you're going to get, right? Yeah. I just haven't seen it manifest where it's like, this quadruple or 4 times what it actually was. And so I'm not saying it can't happen. I'm just saying, you're that would be money where I would be like, I really don't need it. I'm just going to roll the dice. And because I believe in the industry, I'm going to reinvest this portion back into this PT stock because I believe in the industry so much, but I don't need it. I'm not depending upon it. That's how I would look at that.
Yeah. I'm glad you said that, because my friend who called me a week and a half ago said that someone's proposal, it wasn't necessarily a letter of interest, but he talked about earnouts, and I don't get a good feeling about earnouts when it comes out.
I think your intuition is right. Again, I'm sure there are examples where it's worked for people. I just haven't seen it be really successful. Just because I think, again, you're not as you're not as motivated when you decide to sell to really work for somebody else, and now you have to, and I don't think the outcome's going to be as profitable for you.
Yeah. And what can you tell owners about maybe carrying the note on a practice?
Like them selling to someone else?
Associate.
Yeah. So look, I think you have to be open to that. And I think it can actually be a good thing for a number of reasons. Number one is the tax situation. Like when you do a seller financing, it's like an installment sale, right? It's over a period of time. Okay. So whether it's 5 years, 7 years, 10 years, I mean, the nice thing is you can structure it any way that you want to. So that would certainly minimize the capital gain tax that you have to pay, because you don't have to pay, in the year in which you got receipt of whatever part of the sale it was. So it can be good from a capital gains point of view, from a tax standpoint. And, I think that, if you're going to do the seller financing, like if you're willing to carry the note, you can charge an interest rate for, more than what a bank would, because you're not, Bank of Nathan, right? You're not Bank of America. So, you can charge maybe that, 7.5% by carrying the note. And yeah, is it more than what that person would be able to get if they were able to get a bank note? Probably, but there's a lot that goes into getting funding and getting financing. And if you're trying to make a deal really, really quickly, maybe it's worth it, to be able to protect the cash flow and not have this huge note on your back.
Well,
So
and in thinking about possible associates that might not have significant backing to come to the table with.
yeah, you're right, exactly, because most of them aren't going to have $700,000 or $2.5 million or whatever amount you would need to buy the practice sitting in a bank account, unless they got a rich uncle that they can borrow from. But most of them aren't. So you're going to have to be open to the concept of seller financing if you want to get a deal done, right?
Yeah.
And then just make sure that you mentor them so that that owner hat that you have, it can work. I mean, I've seen it work where, you just got to mentor the new owners, and they're going to go through their own trials and tribulations, of course. But if you can just train them up, get them a hat that they have to wear, and show them how to run the business, then, I think the risk on you should be pretty low of carrying the note.
Yeah. And
if you've done all the right things.
yeah, and especially for those guys who have established a clinic that's been around for 10, 15, 20 years, it's kind of on automatic, right? Where an associate with fresh blood could come in and just say, hey, there's some things that we could freshen up. We could, bring things a little bit more up to speed. We could do some more innovative things with marketing. Then, yeah, it's primed for them to even push it further than you might have the energy yourself.
Yeah, I think that's right. And, now you have it as an income source for the next 10 years or 7 years or whatever it is. And you're making 6 or 7% on your money. I mean, it's not easy making 6 or 7% on investments now. I mean, if someone can figure that out, please show me. But it's not like the old days where you could stick 5% in the money market and get 5%, right?
Yeah.
And you can't do that anymore. I mean,
exactly.
Almost zero on yields on bank accounts right now, but penalizing savers. Essentially.
So if someone's looking at a potential sale, maybe they're going through it right now as they're listening to this, what do they need to do to minimize the capital gains tax? Is there much they need to consider?
Well, they're actually, most people, when they start their business, there's a certain amount of capital that you put in. They call it that your basis. Like if you bought a stock for a certain dollar amount, that's your whatever you purchase this for is your basis. Okay. So I think the first thing would be figuring out, if I'm going to sell my practice, like what is my capital gains tax going to be, right? So if I have a $50,000 basis and I sell my practice for $2.5 million, I'm going to have to pay capital gains tax on $2.45 million.
Yeah.
And depending on what state you're in, especially if you're like in California or New Jersey or New York or some of these really high state taxes, it's not 20%. It's probably going to be 28%, 31%, 33%. So it's a big chunk of money, right? So, but there are some techniques that you can utilize to minimize the capital gain or defer the capital gain. And one of them, and I'm not going to kill you with like technical terms, but one of them is called what's called a monetized installment sale, which is a legitimate method that you can use to transfer the gain of the tax 30 years down the line. So you get to invest more of the proceeds. You get more of the proceeds up front, and then you still owe the tax, but you don't owe it for 30 years. So you get the benefit of having more money up front to invest, knowing that your tax bills, you pushed it off 30 years down the line.
Wow.
So that's a strategy that we've done with a number of practices that have sold. And but if someone tells you there's nothing you can do about your capital gains tax, just keep asking questions, because there's always something that you can do to minimize that liability.
And where would you recommend people go? I mean, besides the guru,
besides
the guru, Eric Miller, that is Eric Miller. I went through my sale and I asked my CPA, I said, what can we do to avoid this? He's like, this is it. This is what you get. Whereas, and then I found out after the fact, after talking to you guys, that I could have done something.
There are, I think, number one, you have to be on things like this and find resources where you can ask someone like me. Look, we align ourselves with tax strategists that kind of find these, I guess you want to call them loopholes, but they find these strategies in the tax code that you can utilize. And, look, they're all designed, they're all legal, they're all designed for tax avoidance, not tax evasion, tax avoidance, right? Because it's definitely of the mindset that I have is that I'm trying to avoid paying tax. I'm not trying to evade them, I'm not trying to do anything illegal, but I don't want to have to pay, I don't want to have to maximum fund the IRS. So, but you just have to talk with tax strategists and a number of them, and you can find them. You can start calling me, but you can certainly find them, in that somewhere.
Yeah, and I like the mindset. I read a book once, and I don't remember who it was from, unfortunately, but he said the IRS tells you how to not pay those taxes or how to push or how to kick it down the road. They tell you that. You just have to know the IRS code well enough on how to do it. Right?
Yeah, and that I think people rely too much on their accountants to know that. Not that accountants are incompetent. They're there to make sure your taxes are filed on time and they're done right. And they're not necessarily looking for multiple strategies to save you on taxes. That just isn't their mindset. And there's 2 million words of the tax code. Nobody's going to know everything. So that's where I think really having a good tax team, tax strategist, tax attorney, CPA, is important, especially when you're doing an exit.
So what do you tell the owner that's sitting there? No matter what situation they're in, okay, I'm emotionally prepared. I've got this running well. I'm setting aside 10% in revenues, or maybe I've got a good stash, or I got a good profit margin already. Things are going well. I'm not sure exactly how I'm going to exit, but I'll probably sell to a corporate entity. What do you recommend they start doing now? What are some of the actionable steps they can start working on to make it, that's a good question, to improve things?
Yeah, I mean, well, number one, you can always improve your personnel readiness. You can make sure your personnel, because again, a buyer is buying a business, and that's made up of people. So they want to see that you have personnel that is working together, that's coordinated, that there are some systems that people can get trained, that there are the tenure of your staff is good, that the culture of the staff is good. I mean, I did have a client that lost a sale because a corporate came in there and found out that there was some toxicity in the workplace, and they were like, "We're done, right? We don't want anything to do with it." So it does make a difference. So definitely working on your team building and your culture of your organization, I think is really key. Certainly making sure that, well, we can go for a while on this one. Your online presence, I think, is important, making sure that you are really involved in the community, making sure that you are looked at as a beacon of help in the community. So that, I think that's really key. Someone is going to want to buy that's really good PR.
And that's good to note, because, that didn't really weigh much on us back in 2018. And which wasn't that far long ago, but nowadays it's significantly different 3 years later. That social media strategy is important. They want to see that.
Yeah, I think you're going to need to have that as part of your your marketing. Certainly your income sources. Making sure that you have good contracts, that your profit margins are high. Maybe that you have additional services that are easy to deliver, and you're creating a demand for them. I think that's important to have. Your corporate documents and all your corporate records, if you haven't done that recently, should be. Everyone's like, Eric, what does that mean?
What do you mean by corporate documents?
Yes, you guys are all corporations and your actual businesses. So having those up to date, having your I would really recommend, especially have partners, having your operating agreements up to date. So prior to the sale, there's no one's coming back and saying, yeah, but it says right here that I don't have to allow this sale, So I would make sure I get all my corporate documents up to date and current. All my legal stuff is up to date. I'm compliant, maybe have someone audit your contracts and audit what you're doing. Because these are all the things the buyer they're gonna look at. I mean, you've been through the process, right? I mean, they go through a fine-tooth comb. These are all things you can be proactive at prior to sale. So it just makes the process smoother and easier.
It takes the thing that holds up the sale outside of lawyers is just the request for documents.
Yeah.
And so they want to, most owners out there, I would assume, don't have all of their insurance contracts on file.
Yeah.
And that can be hard to get from an insurance company. They're not anxious to give you the contracts for that you have between businesses. So getting those on file takes time. All the agreements that you have with individual employees, they want all those. They want all your LLC documents. They want to know that you're a business in good standing with a certificate from the state. They want all the licenses. They want to know about every single audit that might have happened or questionable offense that might have come across the state board. They want to see anything that you might think, oh yeah, whatever, I can get that anytime I want. Just have it on file. Just get organized. And then we spent hours sitting with the accountants of the buyer, going over month to month financial reports. Like what happened here, what happened there. So we had to bring our bookkeeper on the conference call and show, why did you itemize it this way and that way? And then not only did we look at the financial reports for hours, we talked about the payer mix and how many are you seeing from Aetna and Blue Cross Blue Shield and workers' comp. They want to know all that breakdown. A lot of stuff.
It's amazing.
It's amazing when you're dealing with corporate entities like that, which could be a reason why you might want to talk to associates about purchasing the practice.
But all those things, all those things you can get in order. I mean, you should have your profit and loss statements readily at hand. You should you should be able to print those off fairly quickly. Mm-hmm. You should know how to read, a balance sheet, or you don't have to be like an expert at it, but just, at least understand what it represents. And all those documents should be kept up to date and current and in good standing. Mm-hmm. And I think to your point, these are all things you just got to get in the mind of a buyer. This is what they're going to ask. And if you can show that there's a lot of order, that there's a lot of, there's not chaos, mm-hmm. then, I think it's going to make the process go smoother. And I think the value would be higher.
Oh, it does. Yeah. You can increase that multiple if it's based on the multiple, right, of mm-hmm. EBITDA, is if you can hand over the book with a leadership team to run it for you.
Oh, yeah.
That's huge.
Yeah. I think you're going to get,
people pay more for that.
That's the difference between getting like a 3 to 4 multiple and getting like more of like a 6 to 8 multiple.
Definitely. Yeah. They want to know that you have systems and procedures in place written out. They want to see them, right? They want to see your compliance documents in place for OSHA and HIPAA and Medicare. They want to see that you've done the trainings and when. They want to see all that stuff.
All those
so
things.
It's
and
not
then
your
lease agreements too. If you're leasing your buildings, mm-hmm. they're going to want to see those. So you make sure you have favorable lease agreements. And that of course makes it, I think, because most of these big corporates don't buy the buildings, they just buy the practice. Mm-hmm. So if you do have the opportunity to own your building, definitely own the building, especially if it's a nice building that you can grow into, because the lease agreements that they sign are usually pretty good. They're usually like 10-year, maybe 15-year leases that they'll sign with 2 to 3% renewal increases and triple net leases. So they're really, really good investment opportunities too. Yeah. So, if you can own your building, definitely do it.
And depending on the size of your practice, that might be a greater windfall than the practice itself.
In some cases it is,
right?
Especially when you look at how much rent and income that you're going to get from this thing.
Yeah.
And, it just becomes a really good investment after that, because, the cap rates on them end up being like 8.5%, 9%. It's like, where else am I going to get that kind of return on my money?
Right.
So
exactly.
It's not a bad investment.
Yeah. Well, anything else you want to share with us today as we're talking about exit planning?
I think we kind of hit that. The big things is that you guys do have control over the outcome and the value of your business, and there are little things that you can do just every day to put more order into the business, to increase the value. And that's not only going to benefit, it doesn't really take much to get your earnings number up. And just remember, because we talked about, your earnings is based upon, or the value is based upon a multiple of your earnings.
When you say earnings, you mean net profit?
Yeah, net profit, right?
Yeah.
So like every $10,000 of additional earnings, think about that, is not just worth $10,000 of profit to you. It's worth, on a 7 multiple, it's $70,000 of increased value of your business. You see what I mean? So if you can, you increase your earnings by 100,000 at a 7 multiple, that's a $700,000 increase to the value of your business that you've done. And it doesn't take that long to do that.
Yeah.
Like anybody can do that, just doing some of the simple things that we've said. So I would just pay attention to that, and look at your business as an investment and treat it as such. Leave it better than you found it. And that's always a good saying to say.
Well, and not to make this a shameless plug, but what benefit does a business coach have for people who are hoping to maximize their profits?
There's no shame in that, man. To me, if you don't have a business coach, I mean, I can just tell you, I've had so many clients that have not had business consultants, and I've had so many clients that have had business consultants. And the difference between the two, overall, is definitely night and day. People that have business consultants, because again, it's, a consultant is there, an advisor there is to put your attention on an area that maybe you're not looking at. Okay. And when they put your attention on that area, now you can look at it and say, okay, what do I need to do to fix this or get it better? And that's where I think the value, of a good consultant, as long as they're giving you the right areas to look at, the areas that are going to have the biggest impact on the value of your business, and to be able to increase revenues and decrease expenses and all those things. So that's the value of a business consultant, because they provide that kind of thing. And, the same thing with me as an advisor. My job is to put your attention on the financial aspect of that, and what are the areas that are most important that are going to get you into personal financial freedom. And, it's totally invaluable to have a business consultant. It's an investment. It isn't that much money when you really think about how much, if your practice is increasing and it's growing, and it's because you're getting good advice and people are holding you accountable for that. I mean, just look at the numbers. It's an investment, and it's not much.
Yeah. And you have to be honest with yourself. If you have gone through all this training to become a physical therapist, but somehow think that that means you can be a good business owner, then you're deceiving yourself. And you got no training in owning a business. Typically, if you think that just going out there and throwing up your shingle and providing great therapy is going to make a great business, I don't think you're going to achieve the goals that you want.
No, you gotta, we talk about the 3 roles that you have. You got your practitioner role, your owner role, and your executive role. And most PTs learn their practitioner role in school. No one really learns how to be an owner. That comes from, again, just knowing what your responsibilities are, and, how to be a good executive, I think, comes through training and finding other good executives and what they did. How did they manage their staff? What kind of statistics did they use? What were their key performance indicators? All these things that you can do as a good executive. And then the owner is there to make sure that the practice value is high, the culture of the organization is good, and that there's a purpose for the business, and everybody knows what that purpose is. And that's primarily what an owner is there to do.
Yeah, definitely. Cool, man. Well, thanks for sharing today. I appreciate you taking the time.
Anytime, man.
Dude.
We can roll on any topic that these guys want to talk about.
Oh, dude, I love and I love talking money, so it's always cool to hook up with you, right? So cool, man. Well, I appreciate your time again. Thanks for coming on.
Can I do a quick shameless plug for myself?
Oh, please. I forgot. Yeah. Yes, please. If people wanted to contact the guru, who is Eric Miller, how would they do that?
Go to wealthforpts.com, or you can just go to our website, econologics.com, and we got plenty of material, downloads, and financial success guides that are built specifically for you as a physical therapist.
Do you still have the survey on board, your financial status survey?
Yeah, still have an assessment that we have people take. You can go on there and you can get a snapshot of like what your what your financial scene looks like. You know, we don't ask any personal financial questions. It's just, you know, yes, no, or maybe. It's deadly accurate though, as far as like giving you an indicator of where you stand financially. It's like a credit score. So if you're feeling frisky, you can go online and take that too.
Yeah, and it really delves into a lot of stuff, not just where your business is, but what you have established at home, and you know, your wills
debt,
and
asset
trusts,
protection,
all
estate
that
planning,
stuff.
all that stuff is taken into consideration.
Covers the whole gamut. That's right. Cool. Well, thanks again for taking the time, man. I appreciate it.
It was fun. Let's do it again.
Will do. All right, man. That was good. Thanks for coming on. I think we're still on Facebook, so don't start cussing.
I won't. I'll be nice.
All right. Yeah. So, but thanks for coming on. Like I told the Facebook group, we're going to do this again here probably next month. Dates to be determined and all that good stuff. But we've got plenty more to talk about.
Yeah. Just I mean, I think the survey was a good idea as far as like trying to find out what they want to talk about. But yeah, any topic, you know, investment, financial related.
Of course.
Let's see what they say.
Yeah, cool, man. All right. Well, yeah, and then this podcast episode will probably come out, I think, on the 20th. So here in a couple of weeks.
Okay.
So
cool.
You'll get the email when it comes out. You can share it with your network, all that good stuff.
We definitely will. We definitely will.
Sounds good, man.
All right, brother.
We'll talk to you later.
See you guys.
Bye-bye.